Hello everyone, today we're diving into a topic that's crucial for anyone interested in the US housing market. We've recently hit a milestone that's got everyone talking. The average 30-year mortgage rate in the United States has soared to 7.6%. This is the highest it's been since December 1, 2000. It's a big deal, and it's making people wonder about the stability of the housing market. Let's take a step back and look at the bigger picture. What started as a small issue has grown into one of the biggest financial bubbles in history. It's a story that not only explains how we got here, but also raises serious concerns about the future of our economy. Now, when you look at a chart showing housing prices over time, there's something important that often gets missed: inflation. For example, buying a house for $200,000 in 2000 might seem like a great deal, but when you adjust for inflation, that $200,000 is actually worth about $356,000 in today's money. So, the real value increase might not be as big as it seems. To really understand the housing bubble, we need to look at prices adjusted for inflation. That's where the Case-Shiller index comes in. It shows us the real picture of home prices without the distortion of inflation. And what we see now is startling. We've gone beyond the levels of the last major housing bubble. Looking back at housing price data since 1889, thanks to researchers like Robert J. Shiller, we see that the 2008 housing prices reached heights that were once thought impossible. But today, we're in an even bigger bubble. Up until about 2012, things seemed normal. But since then, we've entered uncharted territory. So, why do I think we're heading for a downturn? Let's talk about interest rates. They've been a major player in the housing market. Over the last 30 years, we've seen a steady decline in interest rates, which set the stage for the 2008 bubble. And after that burst, instead of learning our lesson, the Fed pushed rates down even further. From late 2011 to now, the real price of homes, that's the price adjusted for inflation, has jumped by 66%. This kind of rapid increase is unprecedented, except for the period leading up to 2008. And when you look at the historical averages, it's clear we're way off the mark. If you're not convinced by just looking at home prices, there's more evidence. Let's talk about the relationship between Treasury yields and mortgage rates. Most people buy homes using a loan, like a 30-year fixed mortgage. The rates for these mortgages are closely tied to the 10-year Treasury yield. But here's where it gets interesting. There's also a 2-year Treasury note. And right now, the government is paying a higher interest rate for borrowing money for 2 years than for 10 years. This is unusual because normally, the longer the borrowing period, the higher the interest rate should be. This situation creates what's known as an inverted yield curve, which is a strong signal of an upcoming recession. Historically, every time we've seen this inversion, a recession has followed. And right now, we're seeing this inversion again. You might think that since the curve is starting to normalize, we're out of the woods. But the reality is, the worst usually starts after the curve normalizes. Take 2008, for example. The real trouble began years after the inversion. Currently, the bond market is signaling that it doesn't fully believe the Fed's approach. Investors are wary, and this is reflected in the yields of Treasury notes. For instance, the yield on a 30-year Treasury is almost the same as a 10-year one. This suggests that investors are expecting significant inflation in the future. Let's break this down. If investors think inflation will stay high, they'll demand higher interest rates for longer-term loans. This is why the 10-year yield can offer the same return as a 30-year one. It's all about balancing the risk and reward. Now, if you're finding this part a bit complex, don't worry. The key takeaway is that the current Treasury yields indicate that investors are expecting more inflation. And if the Fed raises rates to combat this, it could trigger a crisis, the collapse of the housing market. This brings us to the heart of the matter. Rates are like gravity for the housing market. And as we venture into these uncharted waters, a break in the system could bring down the entire structure that's been building since 2012. The bubble we're in now could dwarf the one we saw in 2008. So, what does this mean for homeowners and investors? For homeowners, especially those with adjustable-rate mortgages, or those looking to refinance, rising interest rates could mean higher monthly payments. This could lead to more foreclosures and a flood of homes hitting the market at low prices. For investors, particularly those who bought properties expecting them to increase in value, a drop in prices could be disastrous. They might find themselves with properties worth less than what they owe, and their rental income could also decrease. As we wrap up, it's clear that the U.S. housing market is facing a critical moment. Understanding these dynamics is crucial for anyone involved in the housing market. Thank you for joining us in this comprehensive analysis. Please support our channel by liking and subscribing for more insightful content.